Okay. Yes, sure. This one, I suppose until revaluation means we already covered everything. Okay. Revaluation. Probably we'll do one or two questions later. So IS 12 is on current tax, no issue. This year's tax, we plus or minus last year under over provision. Correct? Current year tax. And the most difficult one has to be the deferred tax. Deferred tax is either with the deferred tax asset or liability. So what gives rise to liability is because it's taxable in the future. There's a temporary difference. And how to get temporary difference? Current carrying amount compared to tax base. So when a carrying amount compared tax base, then you have a temporary difference, either taxable or deductible. Taxable means taxable in the future. What do we do now? We recognize liability. If deductible means deductible good, means we can recognize the asset now, subject to this condition. Remember? So three reasons why we may have deferred tax asset: deductible, temporary. Okay, same thing. These two is due to carrying amount compared with our tax base. And unused tax losses, unused tax credit. This one is for your tax. So if I use unused tax losses means if I have losses in year one, 100. So what do I do in year one for this unused tax losses? I can recognize deferred tax asset. Why? Because in the year two, if I make $100 profit, normally I pay 30% tax. Means I have to pay $30. But because of these unused tax losses, I can claim these unused tax losses. So basically I pay zero. So I pay zero because of these unused tax losses. Therefore, I can recognize the deferred tax asset now. Can help me to reduce my tax. Of course, loss is not good, but at least it can help to reduce my tax. But what happens is, if my profit I expect only in the future, maximum, maybe I make 20, 20, 30. So I can only make 70. In the near future, means I will not be able to utilize the whole $100 unused tax losses. I can only utilize 70. Means I can only recognize up to 70. Yes. So you see, this is unused tax losses. And just now, if I have 100, I can utilize everything, right? Utilize because unused tax losses. Because I won't have to pay tax on this profit. Yes, correct. So means I will pay zero. Otherwise, I will pay $30. But because of this, I save $30. So means I will save me $30. Why? Because I times with the tax rate. Okay. But if I can only earn 70 in the near future, means I will only be able to utilize the 70. So I only take 70 and I times with 30%. So I recognize 21 as my deferred tax asset because I can only utilize up to 21, save $21. So that is what I mean by this. Deferred tax asset should only be recognized to the extent up to how much? Up to the amount that I think I have enough profit for me to reverse this $100. Okay, so and we know the TTD will give rise to DTL, DTA. So any increase or decrease will go to PNL. And the problem is, how do we get a TTD? How do we get a DTD? We compare this one is my 1 year. One asset with many years. So because both can claim 50,000 in my SFP, carrying amount in my SFP, 50,000, I'll claim depreciation, 50,000. Capital allowance, I can claim also 50,000, but I claim more in the first year. So there's a difference of 40 minus 37 TTD. Okay, I claim more this year. So that I pay lower tax this year, means in the future, I won't be able to claim anymore. So in the future, I'll be taxable. So if I'm going to be taxed on 2005, my tax is 40%, means I will be paying tax extra 1,000 in the future from this same asset. Okay, so I'm going to recognize the DTL liability. Second year, same thing. I claim extra 25, so in total now 5,000. It will be taxable in the future. So the tax to be paid 2. So increase in liability, increase in expenses until one particular year, depreciation claim. But capital allowance cannot claim anymore. Means I'm going to pay a lot of tax. So that is when it reverses. So there will be no more temporary difference because now all claim 50, claim 50. No more temporary difference in terms of accounting profit and taxable profit. Both has claim 50, no more temporary difference. Okay, so from liability becomes 4,000 becomes 0 is an income. Okay, so can you see here? My deferred tax will reduce. But in year 5, I have to pay more tax because I cannot claim capital allowance. Cannot claim capital allowance, I pay more tax. Deferred tax come in as an income. So they come in as a balancing act. Okay. Then we did discuss here on interest if it's cash basis, means accounting is always accrual basis. Tax can be accounting, can be cash or accrual basis. If both accrual, actually no issue, no difference. However, some is on cash basis, we put a 0 here. One example, prepaid. I paid 15,000, whereby my interest, my rental is only 12. I prepaid 3. And this example here, it will be on deducted on cash basis, means if I pay 15, I can claim 15. So accounting, I claim 12,000. But tax, I can claim 15 because it's on cash basis. So I'm going to claim expenses or deduction 15,000. So this year I'm going to pay lower tax. Next year, I can't claim anymore on this 3,000 because this 3,000 will be my expenses next year. Cannot claim anymore means next year I'm going to pay more tax, taxable temporary difference. Okay, so I have so many times TTD, it will give rise to DTL 114. If my opening is 0, 114, now of course it increase liability expenses. Provision, I make a provision because IS 37, I have present obligation, probable and outflow. So I make a provision but I haven't paid a single cent. If it's on cash basis, haven't paid a single cent, cannot claim. But provision accounting, I already claimed 10,000 provision expenses profit now. Haven't paid a single cent, cannot claim deduction yet. So this year I'll pay more. But next year, if they return the goods, I pay the 10,000, next year can claim. So next year is deductible in the future. So deductible means DTA, but we have an asterisk here means it is subject to some condition. Means we make a provision to the extent that is probable that future profit is available. Okay. Then on revaluation, so any increase or decrease, we know you go to P&L, deferred tax, increase, decrease, P&L. But there are some increase or decrease may not have to go to P&L, we go to equity. So over here, the increase, my revaluation was 300,000, 15 to 18, increase 300, but my tax base will remain the same. The amount can be deducted. When I buy the asset, I can claim 1515. However, I have revalued, tax also can only claim 15 because revaluation is purely accounting adjustment. So 18 minus 15 is 3, TTD. TTD will give rise to DTL, 0 to 90. So any increase or decrease that is due to revaluation, we don't charge to SPL, but we charge to revaluation, which is 90. So we credit deferred tax. We're going to debit our RR. Okay, now here, when I debit and credit RR, any increase in my RR, in this case is 100, no, 190. Debit, credit, deferred tax, and I'm going to debit R. Do not charge to retained earning or SPL, reverse of R. Okay, because this deferred tax is due to revaluation, therefore reverse from revaluation. cannot. In my SPL, sales all the way to profit before tax, which include current tax and deferred tax, plus or minus profit for the year. We have OCI. OCI will be our gain on revaluation. 300 will come here. When we reverse out 90 for the deferred tax, we must reverse from here as well, 210. Okay. So we try some question from here. So we have done number 3. Let's try number 6, page 135. Shop liability. $35 $175,000 over provision paid. So the amount charged is expenses 67, income is 7. 60 expenses. calculate deeper tax. Yeah. This one simple. You see little, or you the long question one I miss published count. You see actually not too difficult, so not too difficult. MCQ one, you know, something like that also. We have done quite a few here. This one all taken from your revision kit, so you can start doing now. And probably later I'll show you one or two on deeper text. Okay, I haven't printed out the notes, but I'll show you here. Possible on both sides. MCQ means everything, but when come to the subjective question, if it's single entity, then yes. Single entity, definitely we're going to have a deeper text. You see later, or I'll show you later. Now we have try one more if you have any devaluation. No more. Okay. Yeah, number 16. Okay. Answer A. because of the revaluation here, property revaluation. If you look at this example, it involves property revaluation. The director estimated the provision for income tax is 9, so this is current year provision. Deferred tax provision will be 11.2. Your provision at the end is 11.2, of which out of the 11.2, 2.4 is revaluation. So given here is 11.2, of which 2.4 is revaluation. So RR is R, yeah. So when you add up, carry down, brought down is including the 2.4. So this one is my income. Including in this 11.2 is 2.4 RR. But this example, property revaluation give rise to a deferred tax of 7.5. So we know this one deferred tax is 7.5. This has been included in the deferred tax provision of 13.5. Means 7.5 also included in here already. Bring up 7.5, and the balancing will be on this side, credit side. Here 13.5, here is 12.87, 12.7. So the SPL charge is 800, balancing expenses. Okay. This 800 should be here, no space. Expenses 37.2 and 0.8. 38. Yes. Okay. If you look at, I haven't printed out the notes for you for single entity, but I'll show you one or two examples of single entity, how easy it is. Hmm? Yeah, expenses. Why? Okay, now let me check. There should be 38 minus 16, right? So you have 37.2 expenses, correct? And another expenses 800, so 38. What happened? You go and you did minus this. Then no. So you must. Yeah. Current tax and deferred tax lah. Both also expenses. So you just add. You see this one? This is income because here will be 19,200 minus 11. So the difference is 8. This is income. This is expenses, income. So you minus 1. Okay. So it should be current and should be this one. Expenses together with this 8. Minus 1. Okay. I'll show you this one. I haven't printed out the single entity yet. Single entity one, but I'll show you some example on your financial instrument and also deferred tax. Remember financial instrument? IS 32. You got amortized cost, compound instrument. Remember amortized cost? Correct. financial liability, equity, is very important to classify them correctly because this one will affect our gearing ratio. And liability, we have an expenses. Equity, we pay dividend, which is not expenses, and we focus on amortized cost. Amortized cost. Equity, no remeasurement means after we issue, the issue cost will minus from the share premium. When the share price up or down, doesn't matter, it's shareholders profit or loss. Nothing to do with us. No remeasurement on our side. Then financial equity, financial asset when we invest in company share. Company share, it can be valued at fair value through profit and loss means any increase or decrease will go to P&L. This one? Increase or decrease go to OCI. What about the issue cost? If it's P&L, issue cost go to P&L. This one? Capitalized. Number. So, this example. You don't have it yet. I just show you only. Because I won't print out for you yet. So I thought I'll print out, then I'll show you later. But since we are this financial and before tax, I'll show you two examples. You see here, this is a single entity. You're asked to prepare a new SPL or SFP. Investment at fair value through profit and loss, meaning this company has got an asset of 12.5 on 1st April. We are 31st March. Means this is beginning of the year. Beginning of the year. True profit and loss means any increase or decrease go to P&L. Refer to note 4. The investment at fair value through profit and loss is held in a fund whose value, okay, the investment is held in a fund whose value changes directly with the proportion of the market index. On this date, the index is 12. And then the index increased to 1296. So what happened to my investment here? Up or down? The index has increased from 12 to 1296. Index up means my investment also go up because they say here they changes directly in proportion to the market. So increase by how many percent? 1296 divided by 1200, right? And if this is the percentage increase, means my investment of 12.5 will also increase by the same proportion. How much is my investment value now? The value of my investment now is 13. From 12.5 become 13. Fine. Increase by 1 million. Must I adjust? In the notes means haven't adjust. We have to adjust. Up by how much? 1 million. Okay. Debit investment. Credit income. The income will increase my retained earning. Profit for the year will increase. Debit investment, credit income. So if you know this adjustment, 1 mark. You cannot done. Financial instrument. For F7, not too difficult. Then we look at the deferred tax. Here. During the year, over here, the trial balance here, we have a deferred tax again, 1st of April, means this is opening deferred tax. Opening deferred tax of 19.2. Haven't subject to any adjustment yet. 19.2, liability. During the year, the company's TTD increased by 10. TTD last year, compared to this year, it has increased by 10. Means last year 30, this year will be 40 lah. Correct? If last year is 60, means this year will be 70. TTD increased by 10. Did they ever tell us last year how much? Did they not tell us this year how much? But increased by 10. Okay, not? Of which 6 million is related to revaluation. So 10 million, 6 million is related to what? To the revaluation. Means 4 million and 6 million. One is the normal one. 6 million is due to revaluation. And the 10 million must be times with the tax rate. Yes, we have to times with the tax rate. So tax rate is 20%. 6 million due to revaluation, 20% is 1.2 million. What do you do with this 1.2 million increase? SPL or RR? Yeah, we have to reverse out from RR. What about this 4 million which is related to other assets? This one will go to retained earning, right? P&L. Okay. So you see the 1.2 million which must be reversed from RR. How much is my RR now? 18. I have to reverse out 1.2. You check the answer here. You have the answer. What happened to my deferred tax? Revaluation. It was how much as well? 18, right? It was 19.2. It was 19.2 deferred tax and increased by this much. 2 million. Because my temporary difference increased by 10 million. 20% will be 2 million, so 21.2. Can you see? 21.2. 90 million increased by 2 million. And remember, not all 2 million go to P&L. 0.8 go to P&L. 1.2 go to RR. So you look at the answer here. 0.8 go to RR. Retained earning. Where is it? There. 0.8 were used to reduce our profit. 1.2 will be used to reduce our tax, our revaluation reserves. That's my RR. 22.8. How much is it just now? 19.2. No, revaluation. $18 is my this one. This one was how much? 18, and this one is plus 6,000 revaluation. Remember, revaluation up 6, we must down by 1, 2. This one. Up 6, down by 1, 2. Wait, I show you. No notes, very susah. Up 300, down 90, right? So this example is I up 6,000, and because of the RR, I have to minus up 1, 2, right? 20%. So my deferred tax or revaluation, it was 18,000 original. There's a revaluation made during the year 6. Then it's stated here in the question just now. 6 million. Increase of which 6 is due to revaluation up 6. We minus out 20%, 1, 2. So up 6 minus 1, 2. So 18 plus 6 is 24. 24 minus 1, 2. 22, 8. Cannot. So this is on financial instrument just now. Increase. Go to P&L. This one deferred tax involve revaluation. Any question? Where's the 4,000? Oh, 0.4. Which one? Increase 4 million means 20% means increase by 0.8, right? 4 million is TTD. 4 million TTD means give rise to deferred tax liability. Okay. You see what happened is, I'll show you this example. This one halfway. When I got a TTD, means I got a carrying amount minus my tax base. I have a TTD, right? Correct not? Something minus something, I got my TTD 50. If my tax rate is 20%, means it will be $10. Let's put it here as 80. If my tax rate is 20%, means my TTD will be, my deferred tax liability is 16, correct? Opening is 16. Year 1. If year 2, carrying amount minus tax base increased by 10. So this is 90. Is it okay? It will be how much? 18. The increase is 8 to 18. So how much is the amount charged to SPL? We know it's 2. Okay? Amount charged to SPL is 2. But what if I tell you here, my TTD has increased by 10. If 10 I times with 20%, 2. Means the increase is actually my expenses. Increase by 10 is actually my expenses here. So when you apply to this example, temporary difference increased by 10. If 20% means increase by 2. But all the 2, this 2 million, not all charged to P&L. 1.2 will be reversed from RR. The balance will be charged to P&L. Can see? So this is how they put it, your exam. They did not give you specifically this minus this, then TTD, you times or whatever. No. It can be this, it can be those. You see one more? Until I give you the notes, then you do a proper one. Okay, here. Number 5. We have a note on deferred tax. 5.8. We have a note on what else? Current tax do we have? Okay, don't have. So we have a deferred tax. Alright. The director estimated provision for income tax for this year is 11.4. So 11.4 is current year provision. Okay. The required deferred tax provision for 2008 is 6 million. Last time was how much? 5.8. This time I'm going to make a provision of 6. So income and expenses. 5.8 is a liability. This time around, they give us 6 million. They did not give us TTD or whatever, straight away tell us, hey, 6 million. So is it increased by 200? So this is my deferred tax. 200 is my expenses. So how much is my total expenses? 11.6 is my tax. This one very easy. Current tax, deferred tax. Okay. Okay. So that's when you ask deferred tax how? It is long question will be something like this. Normally these two come together. Okay. Done. So just now we discussed a few examples, or we recap deferred tax, and we did 2 or 3 questions on deferred tax. We haven't started anything new. Okay, we're still on deferred tax. And now we're going to start with new standard. Which one? We use this one? The note. Just now is when you join halfway we were discussing is another note. Haven't printed yet. Just to show them on deferred tax how they ask, financial instrument how do they ask. Okay, foreign exchange settle, foreign currency. Remember we learned the functional currency, translation, conversion, two different things, conversion and translation. Now we'll start with IFRS 15 first. We skip 16, we'll start with 15. Page 149. IFRS 15 revenue contract, revenue from contract with customer. This is a very long standard. Okay, and it's newly introduced in 2000, I think like 2 years ago. Okay, so it's a new standard examinable starting from 2 years ago. It's a combination of two or three different standards, a few standards lah. So it's the old IS 18, the old IS 11, no more. Now they actually combine in one revenue from contract with customer. Okay, IFRS 15. The next standard we're going to learn will be IFRS 16. Okay, so this one 15, the latest one will be 17. So this particular standard deal with when do we recognize the goods and services that we sell, and how much. Okay, more on recognition, more on measurement. Okay, so you see sometimes when we sell the goods, we will deliver the goods, we bill later, correct or not? Deliver the goods, we bill later, and then the money will be collected later. So delivered, bill, and money collected will be 3 different dates. Correct? So when should I recognize? So everything will be explained here, IFRS 15. That one is straightforward. Later you will see some very complicated examples. Then you have to apply their understanding here. So the keyword that we should look out for when we want to recognize the sales is when there's a transfer of the control. Okay, control over the assets. And normally control is transferred when the goods are delivered. Not the goods are billed or when the money is received. No, it's when we deliver. That's why once the goods are delivered, we can recognize the sales because control has been transferred. Means if I sell tire and they manufacture Toyota, the tire once are delivered to them, can they use the tire? Can. They have control over the tire, not me, because it has been delivered. Even though I haven't billed them, I haven't collected from them the money. Yeah? So this one is just important one is the control. And 2.1 is the apply to our contract with customer except for bullet point 1, 2, 3, 4 because we have other standards to deal with. Leasing, we're going to do that. The next one, can you like add in here? leasing, this is the old one. The new one will be IFRS 16. Contract, not in the syllabus. We don't care about investment insurance contract. Financial instrument, yeah, we just finished IFRS 9, 10, business combination. All right. Okay, anyway, this bullet point you can skip. Now, income is all types of income. Revenue is your main income from your main business. All these are under IFRS 15. Okay, not income, revenue. So revenue, let's say I sell tables and chairs. So my revenue is from selling tables and chairs, revenue. Income can be gain on disposal, can be anything. All right. If the notes at the bottom, when I collect sales tax or GST, is it my income? No, it is not my income. Okay, not. So revenue does not include any sales tax, value added tax or GST, okay, or any other taxes collected on behalf of the party. Okay, not. So this particular standard is on revenue. So we do not include GST, we do not include sales tax. Now, recognition and measurement, we have 5 steps. So the 5 steps will be COPR, COPR. Let's underline what is C. C will be the contract. O will be the obligation. P will be the price. A will be the allocation. R will be the recognition. Okay, na? C will be the contract, performance obligation, price, allocation, as well as recognition. 5 steps. Okay, so each of these we have an example. You see, IFRS 15 involve a lot of judgment. Okay, now 5 steps, and each of these 5 steps here we have a lot of judgment to be made. Therefore, when it comes to recognition of revenue here, especially the complicated one, you have to use a lot of judgment. So number 1, when should I recognize the sales? The 5-step model is, first of all, there must be a contract between 2 parties, correct? The contract can be written, the contract can be oral. There must be a contract. Okay, no? So a contract with a customer within the scope of IRS, only when the party approved contract are determined to carry out. Each party have rights regarding the goods and services, and so on and so forth. So there must be a contract. So when the contract exists, the next thing is we need to know, go through the contract to see what is the performance obligation. Okay, especially identify separate, because in that contract can have more than one performance obligation. Meaning, if you pay me money, you're going to pay me money here, and I'm going to sell you the table. So money collected, the obligation here is to deliver the table. One obligation. You pay me, I give you my tables and chairs. One obligation. Is it okay? But there are some contract that actually has got more than one obligation. One example will be if you sign up contract with Maxis. You sign up contract with Maxis. So what do they give you? They give you handphone as well as telephone line, correct? So you actually pay $100, example, and you get a free handphone as well as the line over a contract of 2 years. So the $100, is it for 2 things? The $100 here is actually for 2 things. One is for the handphone, one is for the line. So we have to identify in the contract Is there one, or is there two, or is it more performance obligation? If yes, then the $100 that you pay, okay, the transaction price, we have to identify and allocate them accordingly. Out of the $100, how much is for handphone? How much is for the telephone line? We have to allocate. Then we're going to recognize separately. Okay, not recognize. Can you see COPAR? So it's 5 steps to recognize our revenue. First of all, is there a contract? Yes. So how many obligations are there? Is it one or is it more? If we have more, then we have to determine the price. Once we determine price, then we do the allocation to the performance obligation. Once we have allocate, we're going to recognize. So we have example on identify separate performance obligation here. Identify, turn to page 153. Office Solution, a limited company, has developed communication software package. So there's a package here called ComSoft. The Office Solution means the company has entered into a contract. So yes, there is a contract with Logistics. Office Solution has got a contract with Logisticity to supply the following: license to use the software, license to use the software. Then in the contract, they say they can installation of the services. So install the software. This may require an upgrade to the computer operating system, but software package does not need to be customized. Okay, not? So we have the license to use it. Then you can have to use the software. No need to be customized. Means you have one core software here can be used for many people here. Similar one. Technical support is for 3 years. Means you use my software, I'll provide you with 3 years support. And 3 years of updates for ComSoft. Support is like maintenance support. If there is any update, you'll get the updates from the company. Office Solution is not the only company able to install. So when talk about installation, Office Solution is not the only company can help to install. And technical support, we are talking about C, can also be provided by other company, not just the company. And software can function without any updates. So software can function without any updates or technical support. Means B, C, and D can be done by other people. Okay, can be done by other people. Installation can be done by others. Technical support, they mentioned here, can also be provided by others, as well as update, not necessary, without any updates or technical support. So, enter into the contract. Number 1, yes. C, obligation. Identify separate obligation. So from here in the contract, how many performance obligation do you think that there are? How many obligations are there? B, C, D, all can be done separately by different person. So they can be separately identifiable. Cannot and can be provided by different person. So over here, therefore, this contract here comprised of 4 performance obligations. Okay, let's go through here. ComSoft was delivered before the other goods or services and remain functional without any updates or technical support. No need updates, no need support. Either on their own or together, the promise to transfer are separately identifiable. Means the 4 items here, the license, the installation, technical support, as well as update, can be separately identifiable. It's 4 different things. Just like the handphone, we know the handphone together with the line, separately identifiable. Is it okay? If I sell tables, of course the table we got a panel together with the stand which we screw together. Can we call it that separately identifiable, or can they sell separately? No such thing. They come together one. Okay, not? Otherwise you got thousands of components there. I mean, if it's a car, then you want to recognize separately. No. So it is identifiable separately, and they can be sold separately. In this case here, they can be sold separately. A, B, C, D. Okay, it's not like table whereby you combine together. It's not like they can be sold separately. Okay, so if it's separately identifiable, then we have how many distinct, the obligation is very distinct, means very different from each other. Therefore, we have to identify 4. Okay, 4 performance obligation. There here. Step 2, done. What is 3? Price. COPR, price. So determining the price, also another problem, subject to a lot of judgment, because we have to consider a lot of things. Variable consideration. Okay, variable consideration. So we go straight to the example. And before that, we look at the bottom here. Whenever we give discount to our customer, we give rebates or any refund here, we must deduct, take it out. Any discount or any rebates, we must take it out. Okay, now? And example where variable consideration can arise is discount, rebate, refund. Example. Before we look at an example later, I give you one here. Variable consideration, because price, transaction price. Okay, if I sell to you 1 unit $10 with no other condition attached, the price has been fixed $10, no issue. But when you bring in discount, then we got variables already. Why? I sell to you 1 unit $10. If you buy more than 100 units within 1 year, more than 100 units within 1 year, I give you 10% discount. 200, then I give you another 5% discount. Can you see here now? We have variable consideration, means variable amount, selling price, because you never know, are they going to sell above or are they going to buy from us 100 units or 200 units, which have different discount rate. That is when we have variable consideration. We have to determine the price, how much, with discount, without discount, how much. May buy above, may buy below. Below means no discount, above means got discount. So are they likely to buy more or buy less? Involve a lot of judgment. Same thing for rebate, same thing for refund. When I sell 100 units, who will return? Okay, 5% return or 2% return. So again, involve a lot of judgment. The variables involved lah. Yes or no, yes or no. Can you see? So we look at some example here. 3.3. Padlock. Supply laptop computer to large businesses. On 1st July, Padlock entered into contract with Trilco. Yeah, there is a contract, number 1. Okay. The contract under which Trilco was to purchase laptop at $500 per unit. So the selling price, the transaction price at the moment now is 500 per unit. The contract states that if the Trilco purchased more than 5, the price per unit will reduce retrospectively to $450. Padlock year end is this much. What do you mean by reduce retrospectively? Means the first 1 to 500 will be how many? 500 units will be $500. If you buy more than 500 units, the 501 onwards will be $450, not the original first 500 unit. Otherwise, this will be known as apply them retrospectively, prospectively. Okay, retrospective. Okay, this one retrospective lah. Retrospective means this one also become 450. Sorry, the one example given to you is prospective. 2 words, retrospective. The other one is prospective. Have you learned this before? These 2 terms? Never? Okay. Retrospective means we go back and give a discount. Example, 1 to 500 unit, I will sell 500. But the moment you buy more than 500, you get a discount of $50 for 50. And this 450, is it apply on the any excess, or can I apply to this 500 unit here? Answer is yes, because it's applied retrospectively. Yeah, you will get $50 discount for the first 500. Okay, I'll give you other example on retrospective. Let's say this is year 1, this is year 2. Okay, you take a course called A whatever lah, ACA or whatever lah. Okay, so this is a accounting course. It's not recognized. So we have many students who pass and pass. Sorry, it's not recognized in Malaysia. Okay, not? Then one announcement by the government that this qualification will now be recognized. Okay, will now be recognized. So now, what happened to these people who passed their ACA, the qualification before? Of course, when you pass here, confirm recognize it. What about those who actually passed before, since the syllabus are similar, okay, except for some changes for the past 2 years? So the government may say, the recognition will apply them retrospectively for the past 1 year. Means whoever that passed 1 year before today, because their syllabus will be the same, because there were quite a few changes, major changes at the mid here. So whoever that passed here, considered recognized. So this recognition is applied retrospectively. Cannot. The other term is prospective. Prospective. Here we have a cyber crime. Someone steal money from internet last time, many years ago, 20 years ago, before the internet becomes so popular, no law or whatsoever. So we have a lot of cyber crime. Then because of that, the government come up with a new law. And someone were to commit the crime here, would they be subject to this new law? Yes. Because some people, they have committed the same crime as this person. Can this law be applied retrospectively? Go back and catch these people? Cannot. It cannot be applied retrospectively. This law can only be applied prospectively from now onwards. Cannot. So Tablop's year end is this much. Not this much on this date. On 30th September means how many months into the financial year? We start off on 1st July. Then about 3 months into the financial year end, 3 months only. Trilco had bought 70 laptops from Tablop. Tablop therefore estimate that Trilco, means we estimate Trilco's purchase will never exceed 500 units. Okay. Means are they going to be entitled for the discount? No. Means we estimate, we use our judgment that they may not exceed the 500. And Trilco would therefore will not be entitled for the volume discount. Okay, no? Then during the quarter ended, means 3 months later, Trilco expanded rapidly, and as a result of a substantial acquisition, and purchased another 250 Tablop. And Tablop then estimated that Trilco would now exceed the threshold of the volume in year 2006. So calculate the revenue for the first quarter. So let's start with A. How much will be the revenue? I sell 70 units. Then we look at the answer at the bottom. Here, I sell 70 units. Each unit will be 500. Why I take 500, not 450? Because I believe they will not exceed. Is it okay? However, in the second quarter, we sold another 250. And by the time when we sell 250, estimate that they're going to exceed. So do you think they will be entitled for the discount? Do you think they're entitled for the discount? Yes, no? Yes, 13? Oh, you understand that? Hmm. They were, yeah. They haven't buy more than 500, correct? But I think they're going to buy above 500. Means I think they're going to be entitled for the discount. I expect them to exceed. Therefore, my selling price would have been 450. Haven't reached. So that's why I said we have to use judgment. So if they exceed, means their 450 will be their selling price. Because I believe so, therefore the selling price will be 450. So the 450, does it apply to now? Actually, they haven't exceed. Should not apply now, correct? Correct. But because I believe they will exceed, so this 250, I'm going to record as 450. So you look at the answer here, we should recognize 109. Why? Because the 250 unit, I'm going to charge 450. So it is 112,500, correct? But why do we minus out 3,005 to get 109? Because the original 70 unit, is it subject to 50% discount already? $50 discount? I expect them, of course, now not entitled. I believe they will be entitled. Therefore, I take 70 times the $50 discount, and their discount will be 3,005. So I deduct immediately from this month or this quarter sales. Cannot? Because wait. So when we have COPR, contract, no issue. Written or verbal is okay. O is performance obligation. Just now we discussed there are 4 performance obligations. It could be 2, it could be 1. Okay, so the bundle package is 2 lah. Means your handphone together with your line. Once we identify more than 1, the next thing is we want to know the price. Should I take 500 or should I take 450? So we use the variable consideration, we use our judgment to determine. So over here is about discount. It could be a refund, it could be a rebate. Rebate also something like discount. So we're going to take the most likely event to happen, which is discount will be given 450. Therefore, we record 450. Even though they haven't sold, we haven't sold 500 units. And the next one will be A. Now that we know our obligation, we have 4 obligations. Our price is this much. 500, 450, so we have taken 450. Of course, not related lah. So now I know the price for this 4. is 450, assuming. How should I allocate the selling price for 1, 2, 3, 4? That one this one A, B, C, D. We're going to allocate. So we're going to allocate based on the price. Higher price, or higher cost, we're going to we're going to allocate higher. That will be our next example. Probably we take a short break. I can sense it. Yeah, okay, great. So we take a short break. Come back, then we do the allocation. Okay. Now is on A, allocating. Okay, allocating of your price to the obligation. COPAR. We have obligation done, the price also done, so we want to allocate the price to the obligation. Okay, now allocating the price, number 3 to number 2. So a mobile phone, give customer a free handset. All these examples are given from the standards. So our textbook BPP also take the same example from the standards prepared by the international board. So a mobile phone company give customer a free handphone when they sign a 2-year contract for provision of the network services, the line, and the handset has got a standalone price of $100. Is given to you free. If the standalone price means it can be sold separately at $100, and the contract is for $20 per month, and it's for how long? 24 months. So meaning you just have to pay $20 for 24 months and you get the handphone free. Prior to means before IFRS 15, the company will recognize no revenue in relation to the handset because it's given free last time. And a total of $240 per annum in relation to the contract, because $20 times 24, it is 480. This is over 2 years, means 1 year will be 240. So we're going to recognize last time 240, 240, 240, 240. And handphone, nothing, because it's free last time. However, under IFRS 15, now revenue must be allocated. Okay, now the transaction price of how much? 480. Can you see here why 480? Because over that 2 years, the company will receive 480 from the customer. So we must allocate to the handset. We must allocate to the handset because delivery of handset constitutes a performance obligation. Handset line is 2 obligation. Okay, how do you determine one if they are separately identifiable or they can sell separately? Then there are 2 obligation. Okay, now 2 obligation, and this will be calculated as follow. What was their standalone price if they were to be sold separately? Means handset would have been 100. The contract over the 2 years would have been 480. So in total will be 580. But how much I receive? I will receive only 480, correct? Not over the 2 years. Okay, so this 480 we're going to allocate based on this percentage. You have lesser amount standalone price, you get lesser proportion. You have bigger standalone price 480, you get a bigger proportion from this 480. Okay, so what you can do is, of course they already calculated 70%, otherwise it will have been 100 standalone price, and contract over 2 years the standalone price separately, it will have been 480. So total 580, you take 100, handset is 100 out of the total 580 times 480. How much you get? You got 82, correct? So here we got 82, meaning the balance will be 480 divided by 580, we times with 480. The balance is how much? 398. Okay, 398. So the 480 we have split between the handset together with the contract of the line. Based on what proportion? On their standalone price. So handset when it's delivered to you, if I were to sell separately, if I sell the handphone to you, can I recognize full? Yes. So the $82 which is assigned to handset, the moment I deliver to you, I can recognize all 82. Whereas 398 is a contract over 2 years. So I'm going to split this into 2 years. So 198 will be first year, 199 will be first year, 199 will be second year. So we're going to split into 2 years. Means in the first year, I'm going to recognize 281. 82 is handphone, 199 is the line. Second year will be the balance on the contract, which is 199. Is it okay? In the old, this is IFRS 15. In the old IAS 18, the handphone will be 0, and here will be 240, and here will be 240. So can you see, with the application of the new standard, we're going to recognize 281. Last time will be 240, so there's a difference of 41 here. Is it okay? So that's how we allocate the 480 into the performance obligation based on the stand-alone price. All right, that is number 4, allocation. Let's go through some of it here. Where contract contain more than one performance obligation. Step 2 already identified, more than one. Example, if it's more than one. If it's one only, very straightforward lah. No need to allocate lah. It's all to them already. But you have more than one, we have to allocate the transaction price. The transaction price has been determined in step 3. The obligation, the different performance obligation determined in step 2. We're going to allocate to all separate performance obligation in proportion to their stand-alone selling price. Just now, stand-alone handphone would have been 100. The contract would have been 480. So based on that proportion, we split. Okay. Now, number 5 also done. When are we going to recognize the handphone? Immediately. Because once delivered, we can recognize the full. When should I recognize the contract over 2 years? Split over 2 years. So when can we recognize? There. Delivered means it is recognized, satisfied at the point in time, straight away. For the handphone, sometimes it can be recognized or satisfied over time, over 1 year. Means more than 1 year, 2 years, 3 years, or 4 years. Satisfied at the point in time, recognized immediately. But the problem comes in when it recognized over time. That example, 2 years, very easy. Later, we're going to bring in construction contract. Another standard, old standard combined into one. That's why this standard here comprises of a lot of things. Okay, that will bring in our construction contract later. Okay. So 5 stacks copper. Okay, performance obligation that is satisfied over time. Just now we are satisfied at the point in time, no issue one. If it's satisfied at the point in time, no issue. The problem comes in when it is satisfied over time. So we will look at this later. Okay, satisfied at the point in time and satisfied over time. Over different period. So we skip this one first. We look at 4.1. Warranty. You know, when I sell something, I include also warranty. When I sell something, handphone, I sell also my television, I also include a warranty. Okay, I sell my car, I include also warranty. So car and warranty, are they two separate performance obligations? Yes. Selling car is one thing. Warranty sometimes is optional. Okay, if it's optional, like you go Seng you can actually extend 1 year, or those electrical shop extend 1 year, pay another $100, extend 2 year, another 150. So the handphone and the warranty come separately. So when they are separate, means we have different performance obligations. Correct? Then we have to allocate separately. Okay, so customer has got the option here. When they have the option to buy, means we have two separate performance obligations. You can extend the useful life, so it's a distinct service. Then we have two separate performance obligation. Then we have to allocate separately. And what other standards will come into picture? IS 37. Okay. However, if the warranty is required by law, whereby they do not have an option to buy, come together one. Means when we sell, we must give the warranty, come together without an option to buy. Then that is when we have to bring in our IS 37. A bit ugly, but I'm going to box it. Warranty, sell with warranty, options or without options to buy. Another type will be principal and agent. Principal and agent. So if you are talking about insurance, AIA, this is the agent, correct? And this is the customer. So this is the principal, you are the agent, and this is the customer, correct? So what will the agent earn? They earn commission. Okay. You will apply this to the supplier. Let's say you go to Lazada. This is Lazada. And then of course they have many seller there, correct? Supplier. So these are the supplier. And you have a customer. So the money of course, who supply the goods? It is the supplier that supply the goods directly to the customer. But when we buy through the website, correct? So is Lazada here or Alibaba, they are just the agent. They do not keep goods, correct? Do they keep any inventory? No, they don't have to. So same thing, if this one is goods, this one is service, they don't have to keep any goods. Services, right? So who determine the price? AIA will determine the price. Correct? And customer may pay direct to the agent. Agent then pay back to the AIA. Customer pay to Lazada. Lazada then pays to the supplier. Okay, goods will be directly supplied to the customer. So don't have to keep goods. Supplier or the principal will determine the price. So this is a characteristic of a principal and agent. Okay, so we have some here. It is principal, over here, 1, 2, 3, A, B, C, D. Another party is primarily responsible for fulfilling the contract. If we are the agent, who is the one that is fulfilling the contract? AIA. Because they have to give support, correct? Not? Coverage. Who is going to supply? Supplier, not Lazada, supplier. So another party responsible for fulfilling the contract. The entity means us do not have any risk. Then we are Lazada, we are the agent, we don't have any inventory risk. Us, we do not have any discretion to establish the price. It is actually determined by AIA, determined by the supplier. But in practice, of course, Lazada, they will force them to give discount. Correct? Not? But of course, the price depends on price. They will decide whether is it the discount allowable or not allowable. Because if it's too much, then how to make money? So end of the day, still supplier. Okay, and to us, the Lazada as well as to the agent, our income is by way of commission. Is it okay? Done. The entity is not exposed to credit risk. So actually, maybe yes, maybe no, but over here means who, if the customer run away, of course, AIA will bear the risk lah. If the customer run away, this one money paid only deliver, so no risk at all. But if customer run away, then AIA will have to bear the risk. Okay, so we are not exposed to any credit risk. Non-payment is not our issue. We earn any commission. Okay. So this will be the example. You can go back and read up lah. So now question. Our exam question will be something like this. Company. So this is my sales. I'll give you one example first, then we incorporate the difficult one. You see what happened? I'm the agent only. I'm just the agent. When I sell 1,000. The cost of the goods is 900. Wait. I sell 1,000. I earn 10% commission. So my commission is it 100? Okay, no. So I will collect. So the question will be like this, yeah. I collect 1,000 from the customer, and then because I earn 10%, what happen is I will pay 900 to my principal. Forget about selling price and cost first. First of all, I receive 1,000, and then I'll pay 900 to my principal. So I retain how much? I retain 100. That is my commission. Is it okay? So under principal agent relationship here, how much should I recognize as my income? Should I recognize 1,000? Then my cost I pay back to my principal 900. Therefore I recognize 100. Or should I recognize commission 100? Which one? Should I recognize the sales, the cost, therefore the $100, or just the commission $100? I should only recognize just the commission. Okay, now? So this should be the way, recognize only the commission as my income. But our exam question, they say this, we have already recognized in our book 1,000, and because we passed 900 to our principal, we recognize the cost. Therefore, we recognize a gross profit of 100. Effect is the same in terms of profit, but here our income is only 100. How much is our income overall? 1,000 with a cost of 900. Can you see a lot of difference here in terms of income and income? Profit is the same. So the correct one should be 100 here. So what adjustment should I make? So the correct adjustment to be made in our book to get 1 mark is you have to minus out your cost, minus out your sales. 900, 900, same amount. Is it okay? So 1 from cost, 1 from sales, half a mark, 1 mark, settle. Okay. So minus 900, 900. But of course, this one is very specific, 1,900. But normally question what they do is, they give you, this is a sales. I change. The company has got a sales of 228,940, and their cost is 19,910. Therefore, they generate a profit of whatever. And then you have a note 1. The company received 1,000, received 5,000. From its customer, in which commission is 20%. The company, I go on, of course I didn't write here. I go on here. The amount of 5,000 received has been recorded into the sales, and the amount transferred, the balance of 80% has been transferred to the principal, which is 80%, which comes to about 4,000. Okay, now? And it has been included in here. So what is my correcting entries? How should I adjust? I should minus and minus. Minus how much? 4,000. 4,000. I keep 1,000 here as my income. Okay, therefore my commission is 20% on the 5,000, 1,000. Keep it there, 1,000. Okay. Repurchase agreement. This one not easy. If not clear, then I suggest give up. But I'm still going to explain. Okay, not easy. This one mainly repurchase. Normally, probably higher level is needed. Your SDR. Okay, we have to focus a lot on repurchase, but at this level here, we focus on the basic first, IFRS 15. This one our repurchase agreement means I sell today. Company, this is my customer. I sell to them, and with a repurchase agreement, transfer to them the asset. Sell, okay, sell asset, and I will repurchase the asset. Sell and repurchase. So when I sell today, I will receive money today, correct? When I sell, I'm going to receive money today. When I agree to a repurchase agreement means I'm going to buy back the asset from them, and repurchase means I'm going to pay money to them. Is it okay? So under repurchase agreement, an entity sell an asset and promise. So me, we are the entity here. We sell an asset and we promise, or we have the option, means whether to buy or not to buy. We have the option to purchase it. And the repurchase agreement generally come in 3 different forms. Sell and I promise to buy. Not just promise. Sometimes I have the option to buy. Means I can choose whether I want to buy back or not to buy back. Option to buy. Is it okay? So we have 3 forms here. An entity has got the obligation, means you must buy. You have the obligation to buy, must buy. Number 2, entity has got the right to buy, means you have the right to buy, but it's up to you whether you want or you don't want, means you got the option to buy. Number 3, an entity must repurchase the asset, must buy, if customer decide and make an option asking you to buy. Entity must repurchase if requested by the customer, means it's a put option. Okay, one is call option, option to buy. This one is the option here is to buy, but whose option to sell? We call it option to sell by who? By the customer to sell. Option to buy, us. Option to sell is on the supplier, customer. Okay, this one option to buy on us. Put means option to sell by the supplier or by the customer. Option to sell. Not within our control. It all depends on them. So for in the case of forward and call, means number A and B, forward and call option, means we have the obligation or we have the right to buy the asset. The customer do not have obtained control. The customer do not obtain control. So back to our original IFRS 15. When can we recognize? The keyword is when the control has been transferred, correct or not? When the control has been transferred, we can recognize the same. A and B, customer do not obtain control because why? Because when I sell to them, I may transfer the asset to them, but they do not have control over the asset because I can buy the asset back. Can you see? Number 1 is I have to buy. Number 2 is I can buy the asset. So who has still got the control? Me. I still have the control over the asset, even though the asset is not with me. Clear? So the entity will account for the contract here. A, lease means I treat it as a rental. B, I treat it as a financing arrangement. Because IAS 17 this is an old standard, we have IFRS 16 will be on the leasing. So we're going to treat this as a rent. If the repurchase price is below the original selling price. Blur it. B, it will be a financing arrangement if it's equal or greater than the selling price. I'll give you an example here. We are a company, this is a customer. I sell to you. Let's use cash rather than an asset. Of course, I receive cash. I sell to you, this is the original selling price, 10,000. The asset is now with them, correct or not? I receive the cash. Then with the option to repurchase, this is sell. Easier. This is repurchase. I'm going to pay them. Below the selling price means 900,000, example. Okay, no? So, today I sell 1,000. 2 months later, I buy back 9,000. So this can be a and B, forward contract or call option. So who actually make money from here? Who take more money in this case here? Me, right? Can you see it's me? I take 10,000. I give back only 9,000. The asset still belongs to me, correct? Not? The asset has not been transferred to them because I still have control. Of course, they use for, let's say, 2 months. The asset they use for 2 months. And they give me 10,000, I give them 9,000 back. So this arrangement here is actually a rental arrangement, leasing. Why? Can you see here? I take 10, I give back 9. What is the net I receive for the 2 months? The net I receive is 1,000. This is my rental. I rent the car to you for 2 months. You pay me 1,000. Can you see? This is rental arrangement. But the contract, they put it as such that you give me 10,000, I'm going to buy back from you at 9,000. So by applying substance over form, this is actually a rental, a lease. Okay? So this is below original selling price. It's a lease, it's a rental. Okay? So we read through again. A and B, the entity will count the contract as a lease, means as a rental, in accordance to IFRS 16, if the repurchase price, which is the 9,000, below the 10,000. We call this a rental of the asset. I earned the 1,000. However, it will be treated as a financing arrangement if the repurchase price is equal to or greater than the original price. Here, I receive 10,000 because I sell. And this agreement is I will repurchase back the asset. Above the selling price. Let's say it is 11,000. Okay, it is 11,000. So now the asset is with who? I sell to them. Later, I buy back from them. I give them 11,000. So this is actually a financing arrangement. This is the net 1,000 rental. I put here rental. This one will be financing arrangement, means a loan. Can you see it's actually a loan? Today I borrow 10,000. I borrow 10,000. 1 year later, I'll pay back 11,000. How much is the interest? Today I borrow 10,000. I pay back 11,000 1 year later. So I'm paying extra 1,000, correct? No? So that 1,000 is actually my interest on that 10,000 loan, which is 10% interest. Okay, no? So the 1,000 I pay extra is actually an interest. It's a financing arrangement in which 1,000 is interest. Is it okay? So both contract I sell asset. Up here I sell asset, down here I sell asset, and I buy back the asset. So under both circumstances, I will buy back, means the asset has not lost control. I will still continue to recognize both as my asset in my book. Repeat, both will still record the assets, both scenario, the asset will still remain in my book. Okay. Then this one will be part C for this one. If we are obliged to repurchase at the request of the customer, means there's an option to sell by them. They means they ask us to buy or not. It all depends on them. We must consider whether or not customer is likely to exercise this option or not. Customer, is it likely to exercise this option? Because it's not within our control. Okay, it's all under their decision whether they want to exercise or not. So when do you think they will exercise? We look at this example here. If the repurchase price is lower than the original selling price, lower, it is considered that the customer do not therefore have any significant economic incentive. They have no incentive to sell. Repeat, two things. Lower than the selling price, original, and they have no incentive to sell. Okay, or to exercise the option, the contract should be treated as an outright sale. What is this? Later we have an example. If the customer is considered to have significant economic incentive, then the agreement will be treated as a lease, means rental. If above selling price, it is a financing arrangement. So we look at this one, example here. So one thing we can conclude here is whether A, B, or is it C. If the selling price, the repurchase price is more than the original selling price, which is similar to this, above the original selling price, confirm it is a financing arrangement. It will be this. Clear? A, B, and C, buy 10, sell 11, confirm a financing arrangement. But what happened? It is part C at the option of the customer. We see two things. Do they have the incentive? Do not have incentive, or do they have incentive? So let's look at the example. When do you have, when do you do not have incentive? So an entity enter into the contract with a customer for the sale of tangible asset on this date, 1 million. The contract include a call option, means part C. Is it okay? Call option is C here. B lah, sorry, B. Call option B. That give the entity the right to repurchase at 150. Give us the right to repurchase. Not obligation, but it's a right. Is this above? Is this above the original selling price? So what kind of arrangement is this? Is this a lease or is it a financing? It is a financing. There, it is a financing. Done. I buy, I take 1 million, I'll pay back 1.1. Means the 0.1 is treated as interest. Is it okay? If on 31st the option lapses and lapses unexercised, means earlier we say we have a right to buy, assuming I do not want to buy. Assuming I do not want to buy, the customer now obtain the control. Then what happened is we have to, the entity will de-recognize the asset and recognize the revenue of 1.1 and make $1 charge to the interest. I repeat, here we will repurchase, correct or not? We will repurchase 11. But what happens if I do not want to buy? Means the asset, is it now remain with them? If I do not want to exercise, the asset now remain with them. So the 1 million here, 10,000 here, I treat it as my income from the sale of the asset. I can now de-recognize the asset. Save. Clear? .6, last one. We focus on the put option. If selling price, no, repurchase price below original selling price. If it's above original selling price, financing option, correct? But if it's below your original selling price, we have to consider two things. Whether is there an incentive to sell or no incentive to sell. Over here. If the repurchase price is lower than the original, we have to consider, do they have incentive or do not have incentive, does not have significant economic incentive or have. So we have to consider these two things. What do you mean by this economic incentive? We look at this example. The same contract as above, sell 1 million, include instead a put option. Now it is a include instead, now it's a put option. Just now it's a call option. Oblige the entity to buy the asset and the customer's request, means not me, but customers will decide whether they want to sell to me or not. They will sell to me if they have incentive. Do you agree? I repeat, they will make the decision whether to sell to me. They will sell to me when they have incentive. They will not sell to me when they do not have any economic incentive. Means it's beneficial to them, then they will sell to me. If it's not beneficial to them, they won't sell to me. Understand? But the selling price definitely has to be below original selling price. So here, and the oblige the entity to buy at the customer's request at 900. Is it below original selling price? Yeah, original selling price is 1 million. Now it is 900,000 below. And the time, the market value is only 3750. Do you think the seller will sell at 900,000? The repurchase price is 900 when the market value is only 75. If you sell to other people, market value only 75. But because there's an agreement for me to buy, they will sell to me at the repurchase price at 9. Do they have incentive to sell here? Yes, they have an incentive to sell. Is it okay? So what happens if they have an incentive to sell? If they have an incentive to sell, it will be treated as a rent. Can you see here? they give me 1,000. When I buy, I give them only 900, meaning I take 100, correct or not? So it's a rental. Okay, but what happened here, if the selling price, market value is 750, the repurchase price is of course lesser than the original selling price. The repurchase price is 600, original is 1,000, market value is how much? 750, and if they sell back to me, they will sell only 600 below the market value. Do you think they will sell? They want to sell it back to me? They won't sell it back to me because they have no incentive to sell. So if they won't sell to me, if they won't sell back to me, means the asset, is it remain with them already? Earlier I sell to them, I get the money. Now they have the option to actually sell it to me. Of course, no incentive, they won't sell, means they will retain the asset. When they retain the asset, means this asset is considered sold to them, outright sale. Here, if they do not have any incentive to exercise the option, the contract should be accounted for as a sale. The asset has been sold to them. Control has been transferred. Is it okay? Let's summarize it here. I never tried before. Now I suddenly thought, okay, let's summarize together. If it's A, what is A again? Obligation to buy, right? We have an obligation to repurchase, means we must repurchase. And B, we have the right to repurchase, means we can choose if we want to buy or not to buy, right? A and B. So if it's A and B, what we have to consider? The repurchase price what? If it's higher than the original selling price, then the treatment will be financing. Correct? If the repurchase price is lower than the original purchase price or selling price, then it will be treated as a lease, a rent. What happens if it's part C? C is what? Is a put option. Put option, right? Means the repurchase is at the request of the repurchase at request of customer. So what must we consider? Is the repurchase price above original selling price? It is a financing arrangement, correct? They definitely want to sell to me. Why? Because hey, I sell to them this much and then I'll buy back even higher. Definitely they will sell to me. Therefore, it is a financing arrangement. But what happens if the repurchase price is below the original original selling price? What must we consider? Incentive to sell means they will still make money from there. So incentive, no incentive. If they have incentive to sell, it will be rent. If no incentive to sell back to me, means they're going to keep the asset, it will be considered as outright sale. Okay. So this is a FRS 15 on repurchase agreement. Okay. How important on this repurchase, I suppose, is not so important. Except maybe you may come up in our MCQ. That's why MCQ we don't discount anything. We have the 60, we have the how many percent? 40%, whereby we can focus on console, single entity ratio, this three. 40%. So okay, objective we got 60%, which is about. Consignment. Consignment will be something like this, like newspaper, the Star Media. They will send the goods to the newspaper vendor in the morning, right? And then the vendor in the morning, 3 o'clock in the morning, while they are still sleeping, they will prepare the newspaper, right? And then what happens if they send to us as a customer? They will deliver like 1,000 units or copies, 1,000 copies. And then newspaper vendor will then take the 1,000 copy and then distribute, or they place it in their store and sell. So if they only sell 900, what happened to the other remaining 100? They return back to the media, right? So why they are just this is a consignment arrangement. Means I don't buy 1,000 and then if can't sell I have to keep. No. So it is actually they send to me as a consignee will sell whatever I can sell. If unable to sell, I'll return back. Okay, you look at those retail shop, Gardenia. Okay, Hi-Fi, same thing. Every few days they go and exchange because all these breeds they have expiry date about 5 days like that. So it's a consignment arrangement. Okay, so we are the newspaper vendor. We are the newspaper vendor. Do we recognize the purchase of the 1,000 copy? We don't recognize the purchase because we don't have to buy. The control is not transferred to us because we can return. See, okay? When we collect the 900 copies, the sales, we still we don't recognize the cost. Is it okay? We only recognize the profit that we share. Okay? Is it okay? So this one almost similar to our commission. Okay, similar to our commission consignment. So you can see here, customer means we are Star Media here. Customer do not obtain control. If I'm Star Media, they do not obtain the control. The product is controlled by us. Okay, the entity can require the return of the product. Means we can ask them to return the goods to us. Okay, so now what happens if I'm Star Media? What happens if I'm Star Media? Can I recognize the sales? Can I recognize the sales of the 1,000 copy when I deliver to them? Cannot, because the 1,000 copy is delivered to them. I did not transfer the control. I still remain having the control of this 1,000 copy. So I don't recognize the sales of the 1,000 copy. Therefore, I don't recognize the cost of this 1,000 copy. Is it okay? Because some of the newspaper may be returned to me. Clear? Done. 4.8, next page. Bill and hold arrangement. go straight to the example. Next page. Entity enter into a contract with customer on this date for sale of machine and also spare part. I entered a contract, so we have COPARC contract. It takes 2 years to manufacture this on this, and on 31st, which is 2 years later, the customer pay for both the machine as well as spare part, but only take possession of the machine, means the spare part keep in the company. Understand? I buy machine and spare part, so after 2 years, I take only the machine, the spare part I keep it with them. I only take possession of the machine. The customer inspect, means we inspect and accept that the spare part, but request that they continue to be stocked in the company's warehouse. So how many performance obligations are there? There are 3. What are the 3? The machine is 1, the spare part is 2, and custodial service means the storage is 3. Custody. So transaction price will therefore be allocated to these 3 performance obligations. How are we going to allocate on this performance obligation here? Based on their standalone price, correct or not? Based on their standalone price. So the machine and the spare part are both performance obligations satisfied at the point in time, because they can be satisfied at the point in time or satisfied over time. And for both of them, that point in time will be 31st December 2009 when everything is completed. In the case of the spare part, the customer has paid for them. The customer also has got legal title, and the customer has got control. Okay, no? Even though I did not take control over the spare part, I keep it there. I have the legal title, means I own it, and I have control over it. It belongs to me. Custodial service are performance obligations satisfied over time. So revenue will therefore be recognized over the period under which the spare part are being sold. If it's spare part stored over 12 months, so I'm gonna pay over 12 months, means the company is going to earn in rental income over the 12 months. It can be 1 year, it can be 2 years, it can be 3 years. Is it okay? So this is called the bill and hold arrangement. You bill them, but the goods did not deliver to them, but I still hold it, I charge you rental income. Is it okay? Done. Still got 2 more very long parts of IFRS 15. So before we continue, for IFRS 15, basically IFRS 15 here is on what, when can we recognize? Of course, we meet the 5 criteria of the 5-step model. Okay, the 5 steps model, first, second, third, fourth, fifth, then we will recognize. The step number 5 is recognized, and the keyword here is when the control has been transferred. So not only that, out of the 5, we got different example on how to determine, especially number 2, performance obligation. We have to identify separate. Means from the contract, we must see got how many performance obligation. From the telephone contract, we must see got how many. And then the price can be variable consideration because it can be fixed. It may involve discount. So we have to use a lot of judgment to determine the price. Once we determine the price, we're going to allocate. But allocation can be recognized now, can be recognized over time. Recognized now means at the point in time, can be recognized over time. Okay? So we have a long example on satisfied over time, especially on construction. Which page is that? Page number 163. A contract where performance obligation is satisfied over time. More than 1 year, especially construction contract. Normally construction will take how many years? 1 year, 2 years, 3 years. Satisfied over time. Okay. Output method, input method. Sometimes output method out, sales method. Input method, cost method. Sales method, cost method. Okay. So we have SPL, we have SFP. For construction contract, we have revenue and cost means SPL. Next page, we have the SFP, the format. Okay, so I'll give you an example. I'll give you an example. Here. Okay, I'll use example 6, page 167. Okay. Performance obligation satisfied over time. I entered into the contract, and the contract price is 100,000. I know my cost is to be around 80,000. So this contract will generate 20,000 profit to the company. Is it okay? So this will be the outcome. The contract, and we call this the outcome. And when do we apply this concept here is normally when the contract overlap 2 different years. Means once we close our accounts, the contract haven't complete yet. Okay, now come 31st December, the contract haven't complete means overlap 2 financial year. So we're going to apply this thing. Here, first thing. We have 2 methods. One is input method, one is output method. Input is cost, output is sales. So other information, cost incurred to date is 40,000. Year 2 will be 60,000. Okay, now, so this contract can be 3 years, can be 4 years, doesn't matter, but we only focus on the 2 years. Amount invoice, I invoice 48. The amount invoice, can you write here also cumulative? Means in total. Number 1, we are using the cost method, which is also known as the input method, right? First, we have to calculate the profit to be recognized. So it is based on percentage of completion. We look at this formula here. We are using this cost method. Cost incurred to date means until now compared to the total cost. That's why we call it the cost method. Yeah. What is my total contract cost? I expect to incur 80,000. Okay. So year 1, cost incurred to date is 40. Out of total contract cost 80. So how much cost, how many percent have I incurred? Out of the total cost method, out of the total 80,000, I have already incurred 40,000 cost. How many percent have I incurred? 50. Correct? I have incurred 50,000, 50%. Therefore, the profit recognized will be 50% of the estimated profit. Okay, times 100% to get the 50%. Then the 50% our times with the estimated profit means I'm going to recognize 50% profit. So how much profit I'm going to recognize? 10. Is it okay? Number one. Number two, SPL. Make it smaller. I need space for SFP as well. SPL, sales. Cost, profit. This is cost method. The profit we have already found, 10. Cost we already have to date, 40. There. Cost method, cost has been determined. The profit has been determined. So the missing figure will be the sales. Not 30,000, be careful, it's 50. So I'm going to recognize 50,000 as my sales, 40,000 as my cost, therefore 10,000 as my profit for this construction contract which is not yet completed. 50% completed, recognize 50% profit. Okay? SFP. SFP, the format will be like this. Here. Let's try to understand this format. SFP, we present this way. Cost to date. Let's say if I tell you my cost is 50,000, 100,000. The cost I have incurred is 50,000, 100,000. And out of this cost here, I recognize 20,000 profit. Is it okay? My cost 100, I top up 20,000 as profit. What can I call this 120,000? If my cost 100, my profit is 20, is it my sales is 120? My sales? Correct. I buy $10. I want to make $2. How much must I sell? My cost is 10. I want to make a profit of 2. So I must sell 12. Same thing here. My cost is 100. I recognize 20 means my sales would have been 120, correct? So I can actually bill 120. Forget about unrecognized loss. Less amount invoice. You see, when I recognize 100 and I recognize 20, I should bill my customer 120 as my sales, correct? But the amount invoice, probably I invoice only 110. I invoice only 110. Billing. I bill them only 110. So how much still considered unbilled? So $10 is considered unbilled. Haven't billed yet. So we call this contract asset because once I bill, it becomes my receivable. I haven't billed yet, is contract asset. Next question is, now that I bill them 110, I bill them 110, if they pay me 90 only, how much is my receivable? 20. One is contract asset, one is receivable. Receivable, they won't pay me 120 because if I bill them 110, the most they'll pay me is only 110. Okay, no? So when I bill them 110, and if they pay me only 90, then they owe me 20. But I still haven't billed them the $10 now. So once I bill them the $10, this one will increase by $10. Got it? So the format will be cost incurred plus profit to get our sales. But this is the amount I can bill. If I bill only 110, therefore unbilled will be 10. It can be actually more. As in means 120, I may actually bill them 135. Means I have overbilled them. This is contract liability. So it can be contract asset, it can't be contract liability. May bill more, may bill less. Okay? So now SFP, we're going to present using this format. Here. What is the first one? Cost incurred to date. To date means until now. How much cost incurred to date? Here, 40,000, which is from here. Plus what? Profit recognized also to date. Why I keep mentioning to date? Because SFP means balance sheet, all the balance until now. It can be last year, this year, 2 years in total. So it's the cost incurred in total, not just this year. So happen is 40 because today is first year. Today incur 40, total 40. But if tomorrow, next year, I incurred 10, what is the cost recognized? 50. This year is 10. However, in total is 50. Is it okay? What's the profit recognized today? 10. So I should be billing them how much? 50. But you look at here, how much I bill them? Amount invoice or progress billing. Amount of invoice is 48. Therefore, 2 is my contract asset. Is it okay? Now my trade receivable. I'm going to add in info. I bill them 48. This is my additional info lah. If they pay me only 45, so how much is my receivable? 3. This is additional info, not here. Got it? Is it next page? No. Okay. First year. Second year will be slightly different. Let's continue second year before left with 7 minutes. This is year 1. Let's look at year 2. Year 1. Let's look at year 2. Assuming this one unchanged. This one may change. Assuming it's unchanged. This is our outcome. And 20,000. You see, construction contract, sometimes the costs are estimated. Sometimes you want to change, okay, use better quality one, okay, delay, all this may change. But assuming this one did not change, this is our outcome. Outcome remain the same. So cost using cost method. We want to year 2, this is year 1, this is year 2. We want to know the profit recognized to date will be cost incurred to date. Now we are in the year 2. How much? I have now incurred 60 out of 80. Means I can rank, how many percent is that? 75%. 60 out of 80 is 75%. So I'm going to recognize 75% of 20,000. Recognize 75% of 20,000. So how much profit? Yeah, I'm going to recognize in total 15,000 profit for both years. Because this cost is for both years. SPL. Straight away year 2. How much is my sales? How much is my cost? And how much is my profit? Because this is cost method, our balancing figure must be the same. Start with profit. How much? Be careful. Not 15, but 5. Why? In total profit is 15. Last year, I have already recognized 10. Means this year P&L, I'm going to recognize profit for this year only. So I'm going to recognize only 5. Total is 15. I can recognize. Until last year, I already recognized 10. Means I'm going to recognize 5 only. What about the cost? Total cost incurred is 60. Recognized till last year is 40. So 20. What is my balancing figure? Sales? Yes. Okay. SPL. Done. Now SFP. We start with cost incurred. To date. To date means until now. How much? 60. What is the profit recognized to date? 15. Means I should bill them 75. Or I can bill them 75. What is the amount invoiced to date? I invoiced them only 70. So unbilled invoice is 5. This is unbilled. We call this the contract asset. Trade receivable. In total, I've billed them 70. Assuming they have paid me 60. Means they owe me 10. Got it? This is construction contract recognized over time. Year 1, year 2 using cost method. Okay. We quickly do this one. I will show you here using. Then you can compare easily. Next week come back. I forget already. Cost method. Okay. Quickly. Work certified means our sales method. So this is the outcome. And number 1, we're going to find the profit recognized. Profit recognized is based on which method? Sales method or output method. It will be work certified. To date means the sales and the contract price. Work certified to date based on the selling price. Sales the value of the project. The value of the project work certified is 60,000. Out of how much? Sorry? Based on selling price, so we based on 120. Just now it's based on cost, correct? Now this was sales method, so we based on the selling price. The work certified means that the value of the contract is 60,000 out of 120. How many percent has been certified completed? 50%. Meaning I will recognize 50% of the profit. Can? What is next? After we know the profit, half will be 15,000 lah. Okay. Next will be SPL, whereby we have sales, we have cost, and we have profit. Year 1, profit is 15 because it's first year, cumulative also 15. How much is the sales? Because this sales method, we put in our sales 60,000. Therefore, the cost recognized, not incurred, recognized is 45, balancing figure. SFP, what's the first one? Cost incurred to date. What is the cost incurred to date? Be careful. The name already suggested here, cost incurred how much? 39, not 45. The amount recognized is 45. but the cost incurred is 39. Plus profit recognized today, 15. 54. Understand? And that meaning I can bill them 54. How much I bill them? Minus amount invoice. I bill them 48. So contract asset is 6. Is it okay? Assuming I add in my own additional info, trade receivable will be 48, correct? I bill them. But they may pay me only 42, 43 lah. Meaning they still owe me 5 trade receivable. Both are current asset. Contract asset is a current asset. Trade receivable is also a current asset. Means I got 2 current assets. Contract asset and trade receivables. Year 2, we have to calculate the profit to be recognized. The same outcome, 120, 90, and 30. So based on sales method, profit recognized will be based on work certified to date, 80,000. Out of 120 means 2/3. 2/3 means 66.6%. Out of 30,000 profit. So I'm going to recognize 2/3 means 20,000. SPL will be sales, cost, and profit. How much is the profit? Yeah, because it's 20,000 minus cumulative from previous year, 15. So therefore it is 5. What about my sales? 80 minus as of previous year. Any previous year, it can be year 1, year 2, year 3, but in this case it's only year 1. I'm only going to recognize 20, meaning the cost will be balancing. 15. SFP, what is the cost incurred to date? 49. What is the profit recognized to date? 20 here. Therefore, I should be billing them 69 in total. What is the amount billed total? 70. I bill more, meaning I have a contract liability. Contract liability. And trade receivable, assuming 70, they pay me how much? 60 lah. So the balance will be 10. Contract liability negative. I overbill them. Is it okay? So one is cost method, one is revenue method, sales method. And the balancing figure is cost. Just now the balancing figure is 6. Be careful. And also be careful with the cost incurred. We don't take 45. We take the actual cost incurred, not the cost recognized. Okay? Done.